What's good, YouTube? Welcome back to the Brown Gen. If you've sort of been paying attention to the markets, you've seen that the S&P 500, the Nasdaq, tons of stocks have been taking a big drawdown. Don't panic. It's not the world ending like you saw in the thumbnail. The reality is the next rendition of our favorite metric, the CPI, is coming to town tomorrow morning at 8:30 a.m. Eastern. Now, just take a look at this. We sort of monitor this sort of metric every single month because it gives us a great indication on whether or not the Fed has been making inroads against inflation. If we take a look at sort of what has happened in the past, which we do here on CNBC, here is how the consumer price index has changed. So in 2020, around the pandemic, pandemic started March, April of 2020, we were down at 0.4% CPI. CPI started increasing in 2020 and 2021 before exploding all the way up to 8 or 9% for all items at the midpoint of 2022, at which point we started to see some incredible and some consistent interest rate hikes. And what that has done is that has reduced the availability of the money supply. And it actually seems to have brought down a lot of this core inflation. And this is very important because the Fed has sort of had this narrative for the longest time that inflation was transitory. This was back in 2021, early 2022. They finally said, hey, you know what? It's transitory, but it's over a long period of time. So now they got involved and they're pulling it back down. So just to reiterate, tomorrow morning at 8:30 a.m. Central, we're going to find out what the CPI data is for the month of July. Remember, it's always released a month delayed. So we're going to get the August CPI in September. Okay. So this is something to measure. And basically, if you're wondering what we want to see tomorrow and sort of how we're going to plan for it, the expectation is there's a 0.2% increase for July. So what does that mean? It means that if we get a 0.2% CPI, that's neutral. I think the stock market will go up. If it's below 0.2, I think the stock market has a significant rally. And the reason for that is every single indication that we can give investors that inflation is under control, rate hikes sort of won't be there. That is people saying, hey, I am more willing to spend my money. And I also know that more people will be willing to spend their money because there'll be more money available. And so people want to get out and front run other people in buying assets. And that's sort of why over the last few days, you've probably started to see the stock market sort of tumble. So if you look, as of the last week, the SPY has actually come down from about 460. Let's zoom out here. So you can see 459 all the way down to 455. Nothing big, like 14 points or about 3 to 4%. This is not a significant drawdown. Like if we sort of zoom out and look at it from a significant time horizon, you can see here the SPY, we were getting close to coming back to our highs. We've slowed. But you can sort of see that here, right? These are our highs back at the start of 2022, back in January, when we were at 483. We went all the way down to the depths back in the summer of last year, the fall of last year, down to 350. And then we sort of rallied up over the last 8 months. And now we're almost close to breaking all-time highs. Of course, every sort of push up, there's always a retracement. Things don't just go straight up, just like they don't go straight down. There's typically a pullback on either direction. But obviously good news. And we have started seeing the CPI prints have been very positive. But when the credit rating got downgraded last week, it spooked a lot of investors. And given that CPI was coming up the week after, we've seen a lot of people more hesitant to sort of buy stocks. We've actually seen a lot more liquidations, people selling out. People like to play these sort of in and out games when it comes to the stock market, especially around key catalysts like this. So if we see 0.2, I think the stock market goes up a tiny bit. If we see less than 0.2, 0.1, 0.15, 0.05, whatever, I think the stock market significantly rallies for a couple of days at least. And if it's a miss, and let's say it's 0.25, 0.3, I think the sell-off continues, and it will continue for probably another week. We'll probably see this S&P 500 drop another 3 to 5% potentially. But remember, all of this is short-term, right? At the end of the day, right, if you were to sort of just look at it from a year-to-year perspective, if you looked only back in January and you look now, that drop is not significant. It's only 20%, or sorry, 20 points, right, from 480 to 460. But if you were to look at this consistently, you see these massive moves up and down over the short term, right? But over the long term, if you just zoom out on the S&P 500, let's look at it on a month-to-month basis. I'm just gonna pull this out. I want to really reiterate this point. Just gonna out. Sorry. What you can see here when you look at this is really the stock market has a clear trend, right? It is, for the most part, just going up. It's a positive slope. Yes, in the short term, we can see dips, we can see all sorts of pullbacks, but if you just take a ruler, go back at any time point to where we are, it's just constantly going up. And this is sort of why you've got to have the long-term approach when it comes to stocks, when it comes to investing in anything that is a sort of long-term asset. Have that approach. Don't worry about the short term. Yes, maybe you lose some money in the short term. Think about the long-term picture. A lot of people can't do that. A lot of people aren't able to sort of get into something, watch it go down 10%, and usually they sell because they're like, oh, maybe it'll go down 100%. The stock market has proven time and time again that it doesn't work that way. And when you hear sort of Warren Buffett talk, he advises people not to stock pick. He says, don't go in there and buy stocks like Tesla or stocks like Apple. Don't go out there and pick your own stocks. Go pick and buy a bundle of stocks like an index fund, whether it's the S&P 500 or any sort of index that tracks that, an index that tracks the NASDAQ. These are fantastic investments for the long term because they have proven throughout the history of the stock market that long term they'll go up. So while you may lose short term, if you just hold, you will see your wealth sort of generate generation over generation. Remember, I'm not a financial advisor, so this is not financial advice. I'm just sort of talking through sort of the way I approach things. I don't really talk about investing in index funds on the channel because no one wants to hear about it. That would be the shortest video ever. 30 seconds. Hey, check out index funds. Best investment that you can make for sort of the most secure gains possible. So what I do is, for index funds, all you want to do is buy it for long term. For everything else, they're more of a swing trade, long-term hold, but like you sort of buy and sell those from peaks to troughs, right? So you buy at the bottom, you sell at the top, you buy at the bottom, you sell at the top. Whereas index funds, you literally buy it, hold it for the rest of your life, and go back at any point in time. That's not the last year. You go, okay, where could I have bought any of these S&P 500 or NASDAQ indexes? You'll see they're all going up, basically. So while we talked about the CPI print and how important it is, it's very important mainly for those who are stock picking. So if you're buying things like Tesla, buying things like Apple, this is where you really want to hold off and wait, right? Like, so Tesla has come down for about $300 in the last, thing here. In the last few weeks, it's come down from about $300 to about, it's come down to like 240, 245. So there is a lot of, anxiousness around the environment. So the guidance and sort of the way you should look at this is like, hey, am I here for the long term, short term? What am I here for? And if I do want to buy Tesla, maybe I'll wait to see what happens tomorrow in the CPI. Like if you already have enough Tesla, which is what I do, I have a ton of Tesla shares, I'm just going to wait. I'm not going to buy any shares on this drawdown because if the CPI print tomorrow is negative, then I'll get an even bigger discount. I'll be able to dip by even further on things like Tesla, things like Apple, Microsoft, right? I like to stock pick among the most biggest popular blue chip companies. And the reason I do that, these are the obvious stocks. These are the stocks that when they're up like 40% for the year or something like that, no one bats an eye. Like when everyone's like, oh, Apple's up. Yeah, obviously, everyone knows and loves Apple. Even if you're not an Apple fan, you have to appreciate their innovation. I don't think anyone sort of is like, whoa, they don't deserve to sort of be a $3 trillion company, right? Which is what they had prior to this recession. So that's sort of how I approach this. Look at CPI as an opportunity to farm more deals, right? If tomorrow the CPI print is negative, this is an opportunity for you. Why? Because you can then buy some more stocks long-term on discount. And I'm not talking about buying speculative stocks here. I'm talking about looking to purchase stocks that you want to hold for a longer period of time. Apple, Tesla, Disney, whatever, right? That's sort of the way I'd approach it. Or you could do it sort of the simple approach, just every single month. And maybe I'll make a video on this. Every single month, just buy 1 or 2 shares of an index fund and just keep accumulating that over time. When people talk about compound interest, this is exactly what they're talking about. So that's pretty much all I wanted to cover. I want to thank you for watching. Make sure you like, subscribe, and share the video, and I'll see you in the next video. Thanks for watching.